Welcome back to another episode of the Lender Podcast. My name is Bryce. I'll be your host. And today we're talking about why I personally choose to not charge my borrowers monthly payments. And I know this causes kind of a lot of flack. I get a lot of heat from other lenders when I tell them that I don't. And we're going to go over and talk about why I personally choose not to do so. But before we jump into the episode, I quickly want to share our sponsor today, which is, of course, Lender. Lender is a hard money and private money loan origination and servicing tool. So many lenders, especially when you're just starting out, they use Excel because that's the natural inclination on where to start. And the thing is that Excel it's not very scalable. So as you start getting more investors, start getting more loan applications, and just all the complexities with running this business, it can get convoluted really quickly. So we use Lender. Lender helps from taking the application from the borrower all the way to servicing that loan, dealing with the origination, collecting payments if you choose to do so, and just everything in between. So if you're looking for a software platform to really manage and scale your hard money lending business, Lender is the perfect tool for you. You can check that out at joinlender, lendr.com, joinlender.com, and get started. Okay, so this is a pretty controversial topic in the lending industry is whether or not you should or should not charge your borrowers monthly payments. And of course, I personally choose not to. Again, I get a lot of heat and a lot of flack from doing so. And I'll share at the end of this episode why I personally choose to do that. But before we do that, let's talk about some of the pros and the cons from charging monthly payments to your borrowers. So first and foremost, let's go over the cons. The first con that I can think of is collecting monthly payments is just a little bit of a burden, especially when you're small. There's a lot of managerial overhead. So think, for example, like just making sure that payments were made, making sure that if they are late, that you charge late fees, all the accounting that's involved with that. And it's, in my opinion, when you're just getting started, dealing with the intricacies of the business is not the most important place to spend your time. You're better off finding better borrowers, and better investors and more investors. Because ultimately, when you're in this business, those are the two things that scale your business and allow you to make more money. And obviously that's why we're all here, right? Is to make more money. So if you're just busy being productive and all these other little things in your business, in my opinion, it's the wrong thing to focus on. Like, focus on what really moves the needle in your business and not just feel satisfied with being busy because you're not really scaling, you're not really growing. So another con with collecting monthly payments is it puts a strain on your borrower. And when you think about it like this, so for example, the reason that people come to you in the first place is because they need money. And I'm not saying like let's do bad loans or faulty loans or high risk loans where the borrower doesn't bring any cash to the table or nothing like that. But the reason they're coming to you in the first place is they need funds. They don't have funds to handle it and do it themselves. And so when you collect monthly payments, it puts an additional strain on the borrower where sometimes projects just don't go well, and you have a sewer line that you have to do or a roof that needs to be replaced that you just didn't really account for and expect for. And so when you're paying these monthly payments, it really can, in my opinion, affect the project adversely. And that's the last thing we want. We want our borrower to be successful and profitable so that we can be successful and profitable. Another con that I think of is higher default risk. When you're collecting monthly payments, it puts more strain on your borrower, and it's a higher risk for default. And that's the last thing we want. Like, the reason that we're in the lending business in the first place is because we don't really want to deal with the properties. Obviously, there are those circumstances in those cases where we do have to go into foreclosure and we do have to take the property back, and then we figure out what to do from there. But I don't want the property. I really don't. I want the passiveness. I want the borrower to be successful. I want them to make money so that they keep coming back to us. And we just have this relationship that just continues to steamroll, so they can grow and we can grow. And so I don't want to put the borrower in a situation where they can just lose off the bat. And again, there's ways that you can mitigate this. You can cut back on the risk by doing your underwriting properly, making sure that they have sufficient cash funds and reserves. But I just don't want to set the borrower up to fail from the get-go. Another con that I see is it increases the complexity of the loan servicing. So we kind of already covered this, but basically it adds additional complexity to collect the payments, to deal with the late payments, to deal with the accounting. And on top of that, sometimes it can actually increase your operational costs as well. Like if you have a third-party CPA or controller who's handling all of your expenses and income and just trying to manage all that in QuickBooks or whatever it is, like your bookkeeping costs can actually be higher. And again, when you're starting out or trying to grow or scale this lending company, that's the last thing you need. Keep it simple, stupid. That is really what we want to do to make sure that we just can continue to grow and build this. And I'm a big fan of choosing a system and sticking with it and not introducing all these additional complexities. So I see a lot of lenders who will, they'll say, okay, well, for you get a 10% interest rate, but you get a 14%, and this is really high risk, so you get a 21% interest rate. We don't want to deal with all that. Like in my company, for example, we charge 3 points and 14%, and that is straight across the board. And we don't negotiate on points. We don't negotiate on terms. Like this is what we do, and take it or leave it. And if you don't like it, then you can go somewhere else. And I'm okay with that. I realize that I'm not the cheapest by any stretch of the imagination, but anyway, just create your systems and stick to them. And so we want to make sure that like we don't collect payments from this borrower or don't collect payments from this borrower just because it kind of ruins our systems. And unless you have those systems in place, you can't scale. Okay, now let's talk about some of the pros. Now, obviously, the biggest pro is we have a steady flow of cash coming into our business as a lender. And on top of that, we also get to take those payments and we give them to the investors. So we're getting a steady flow of cash, but so are our investors, which is great for investor relations, right? If you're getting a paycheck every single month, like ching, 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 ka-ching, 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 like that's great, right? That's what everybody wants because it lets the investor know that, hey, they're top of mind, they're getting a paycheck every single month, the project is progressing how it should. That's great. So it does help our investor relations, and it's also nice to get a paycheck regularly every single month. Obviously, another pro for the lender is it reduces your risk because you're collecting interest payments every single month. So you're still getting compensated. So let's say a project after month 3 or 4 starts to go downhill. Well, you've already collected 3 or 4 months of interest payments. So you reduce your exposure by having some cash already collected on that project. Another pro that I see is it keeps the borrower accountable. So, obviously if they have to make monthly payment obligations to you, it keeps them on track. It keeps your project front of mind as well. If they know that they have to pay you another interest payment, you're more likely to have that project go smoothly when they're just thinking about, okay, I have to pay them again. And it gives the borrower more of an incentive to get it done. When they see this money going out and they're like, okay, I really got to get this project done. Whereas if you don't collect monthly payments, you kind of just like get pressed to the background and you're like, I've got this project, but it's not urgent because, you're not writing these checks every single month. And then one last point that I want to cover is collecting monthly payments definitely helps early project detection. So like if a project is going to fail, let's say you have a borrower and they've made payments for months 1, 2, and 3, but on month 4 they miss. Well, chances are something is going wrong with that project, and it lets you jump in there ahead of time quickly to be able to work with the borrower, resolve the issue, like say, hey, what's going on with this? Like, or did you run out of cash, or why isn't this progressing? And on top of that too, this is kind of just a side note, but same thing happens if you have, a reserve fund for draws. So say you have a $30,000 renovation budget on this project, and the borrower hasn't taken any draws. Well, okay, that's kind of not normal, and it's a quick red flag to say, okay, what's going on with this project? I need to jump in here and see what's going on. So in my mind, those are the pros, those are the cons. But in summary, let's talk about why I personally choose not to collect monthly payments from the borrowers. First and foremost, it's an accounting headache, and I don't want to deal with it. Like I said before, I want to have these systems and processes that help me grow and scale, and I don't want to deal with all the additional complexities that are causing me to work in my business and not on my business. My main focuses are growing my borrower base and growing my investor base. And if I can get those to continually grow and scale, then I make more money, which is a win-win. So I don't want to focus on just the internal systems and processes. It's not where my time is best used most effectively. So I don't collect monthly payments for that reason. The other thing too is before I was a lender, I was a house flipper. I flipped over 75 homes myself personally, me and my team. And I most of the time would work with lenders who did not require monthly payments. Because think about this, we would have a lot of projects going on simultaneously. We would have 6, 7, sometimes 10 projects going on at once. And so if I was paying monthly payments, shoot, I could be paying $40,000 per month in monthly payments to my lender just because they collect monthly payments on all these different projects. And it's very common in this industry to not have cash and just to be tight on cash. Like again, the reason why people come to you to borrow is because they don't have a lot of funds. And again, that's not to say we want to do risky loans, but it's just, it places an extra burden. And as a flipper, I noticed that I really appreciated it. I really liked it when I didn't have to. And then all of the interest payments just got paid up at closing when the property paid off or refinanced. Now, one thing that I do have a lot of lenders say when I tell them that, hey, I don't collect monthly payments, is they say, well, what about your investors? Aren't you obligated to give them, a monthly dividend? And in most cases, yes, I set up my fund in a way that I don't actually have to do that. And it all comes from just setting investor expectations up front. So when we take on a new capital investor, I tell them, hey, FYI, our debt fund is set up in such a way that our borrowers only pay us interest at the completion of a project. And a lot of them get that, instinctively, like, hey, you start this project, it's short term. Once it pays off, then you get your interest as well. And so I tell investors, you're not going to get monthly payments, but we are going to stagger you through multiple projects. So typically if, say someone comes and brings $100,000 as an investor, we'll get them spread across 4 or 5 different projects so that these projects just kind of stagger intuitively, so that, even though it's not really monthly payments exactly on the dot every single month, you might have a project that pays off within 3 weeks, or you might have another one that pays off, 6 weeks later. And then you might have another one that pays off in 3 weeks. And then you have another one that pays off, in 8 weeks. So it's not like they're going the full 6-month term without receiving any payments, because I wouldn't like that either. As an investor, you want to feel like you're making progress. You want to feel like you're collecting funds. And so that's how we choose to do it. We just set the expectations up front, say, look, you're going to get payments, but it's not going to be on a set regular schedule, because that puts me in a bind. And I don't want to have all of these obligations to these investors and be strapped for cash flow too, because that's not the kind of business that I want to run. I understand if investors don't want to work with us because of that, but we just don't choose to work that way. And thus far, it hasn't been a problem with our investors as long as we set those expectations up front. So that's it for today's episode. Hopefully you learned a thing or two. Again, I would love to hear from you whether you do or don't choose to charge your borrowers monthly payments, just because I like to see the different perspectives and see what different people are doing. But that's it for today. We'll catch you on the next episode.